this is kind of the way that we complete the audit process, is to come before you and talk about the results. And so, you've got an audit committee, and we've already met with the audit committee. We went through a pretty detailed review of the audit results, but it's important to come before all of you and do the same thing. And so that's what we're here to do. On the financial statements, we came to what we call an unmodified opinion. So basically, in layman's terms, that's a clean opinion. So you can't get any better than that. Basically, that means that your crew did an excellent job of capturing your transactions during the year and the balances as of year end. And they appropriately put all of that together in that annual financial statement document with the appropriate footnote disclosures in the bells and whistles required by the professional accounting standards. So that's, I think you've got quite a history of getting clean opinions, and something you should be very proud of. On the Oregon Minimum Standards report, so that's that work that we did where we test about 7 or 8 state laws that you're required to comply with, and we had no instances of non-compliance. So clean opinion on the financials, no instances of non-compliance either for state purposes or on your federal grants, and no instances of control weaknesses that are required to be reported to you. And the best we could do is come up with a few observations for best practice recommendations. So that's awesome result for you. So you should be very proud of your crew and the leadership you're providing that enables you to get to that point. So anyway, just don't want that to get lost in the shuffle here. It's excellent news. But sometimes we don't even talk about the numbers. Our audit really is not directed towards the health of the county. It's really directed towards whether your financial statements are an accurate portrayal of the financial results and the balances at a point in time. But I think it's good to look at this. This chart shows you some revenue trends. So we break it down in your major categories of revenues. And one of the things that I really like is the county's ability to attract those grants and contributions from others. So those are federal and state grants. Sometimes they're contributions from developers. They can come from a number of sources. Most of yours are federal and state awards. And look at that, nice trend line there. Charges for services is something you've probably had to be pretty aggressive about and find ways to collect revenues, but appropriately from folks that are receiving services. Property tax revenue's been really pretty flat. I mean, you're only $3 million more than you were 4 years ago. And so property taxes are just a portion of it's a significant portion, but it's not like you're out there really raising your revenues solely from the backs of your property owners. And then you've got some other miscellaneous revenue sources. So it's in some ways for your residents, they should be pretty proud that you're out there finding grants and amounts from outside of the community that's driving a nice for the revenue there, instead of all of it being from property taxes. On the spending side, these are the major categories of the different types of services that you provide. And again, one thing I think the community would be and should be pretty proud of in some respects is the general government piece. Look at that. If anything, you're down from where you were. So obviously, your management crew here, Danny and his staff have had to deal with some declining revenues or financial challenges, and they've done that fairly well with the general government services. Those have not swelled. One thing that's taken a hit, obviously, the community justice and safety. So that's unfortunate. And then you can see in the other categories where you're spending your dollars. Well, you can see 4 years ago, your total cost of providing services here at the county was $159 million, and it's $134 million in this year that just ended. So you're down $24 million from 4 years ago in terms of the true cost of providing the services here to your community. If you look at your fund balance, if you will, or the equity on a county-wide basis, on the same way that a commercial enterprise would put its books together, that first bar is the total. If you took all your assets here at the county and you liquidated them at book value and you paid off all your debts, this is what would be left over. So in 2011, that was $481 million. It's $483 million at the end of June of 15. And what I like about this graph is that it shows stability. The other bars break it down into different components. So the grayish bar, the second one there, measures how much of your resources are invested in things like buildings and bridges and roads and infrastructure, equipment, and that sort of thing. And what I like about that is you actually have an improving trend line there. So what I worry about with a lot of our governmental clients is that when they get into financial stress, one of the things that they'll do is quit those investments in their capital assets. I mean, it's easy to not replace, a piece of equipment, or not replace a building, or not replace a bridge, or do major maintenance, but that cost is still there. The only thing you've done is pushed off when you have to cut the check. Eventually that check has to be cut. So you've been maintaining your capital assets here at the county very well, and that's what that graph demonstrates. The other two bars are your restricted and unrestricted resources. Those are the dollars that you had left at the end of the year where there's an outside commitment on where you spend it. So this could be federal grants that just hadn't been spent for their intended project, for example. And then the final one is unrestricted. So those are the resources that you have available pretty much at your discretion to apply. And those are stable. You probably don't want to be accumulating resources if you don't have a need for it, but you don't want to decline in it either. And so what I see in those is stable numbers. And then, you can ask yourself questions about those unrestricted. How much should I have? And so this graph just looks at your general fund, which is the one that you have the most discretion over. And in your general fund, here's the revenues, expenditures, and remaining fund balance for the last several years. And you can see that for the most part, you've had expenses about equal to revenues, or your revenues slightly ahead of expenses most of the years out of the last 5. And your fund balance has varied between $71 million, and it just ended at $57.3 million at the end of June of 15. So again, we're seeing some stability. It's a little bit down from where it was 4 years ago. And one way to measure, what's an appropriate amount, or what should I have, is there are some best practices out there. And for most governments, what credit rating agencies and those that look, if you were to issue a bond, they look at your general fund balance. And a best practice is a minimum of about 15% of expenditures. And you've varied between 100 down to 75, and now you're at 89% of expenditures as of June of 15. So that's a very, very healthy position to be in.
So I just want to make one comment. This is just to clarify for the public. A lot of times people will say, well, you had $100 million in fund balance, and now you're down to $71 million, $59 million. What are you spending all this money on? I think it's important for the public to know that what we've done is we've taken that fund balance and invested it in those capital assets that you talked about, buildings, infrastructure that the county has needed. In fact, we built over $175 million of capital infrastructure in the 10 years that I've been here without asking taxpayers to pass one new tax. At the same time, we're spending $24 million less a year, as you said, and we're maintaining our assets. So I want the public to know that spending down the fund balance doesn't mean that we're spending recklessly. What it means is we're making important investments. And in other jurisdictions, typically those important investments come on the back of taxpayers paying additional taxes for them.
Yeah, good points. So really lots of good news today to bring to you. Again, I know that it's a challenge to meet all the need in the community. I can't really address that piece of it, but you can't really meet that if you don't have the financial strength to begin to address those needs. And so very good results for you in terms of at least the handling of the financial side of that equation.